What is going on, everyone? Anthony Drew Gary here, host of the How To Show, where we talk about optimizing life, money, and happiness one how to at a time. And this week on the show, we are talking about mortgages, which may be a scary topic for some because mortgages are costing more right now than they have in the last 15 years or so. And it's causing some people to be apprehensive about the entire process of obtaining a mortgage. And so I am a real estate expert. I don't wear that hat lightly. And I can help you transact real estate, but I am not necessarily a lending expert. That is an area adjacent to real estate that I think it's totally recommended that you rely on experts in that craft. And so I'm going to have one on my show today. His name is Kyle. He works in the mortgage world, eats, sleeps, and breathes it. And so we're going to talk about at a high level what is the best way how to get a mortgage in 2023 and 2024 and do it as most efficiently as possible. So without further ado, let's bring Kyle onto the show. Kyle Hiestand, welcome to the How To Show. How are you this evening?
I am fantastic, sir. Thank you so much for having me on. The invite was a warm welcome. Um, I followed you for a long time. Obviously, we've met personally through friends. We have some of the mutual same friends, so it's really cool to kind of talk business and also just talk, hobbies and whatnot and how tos on this video. So I'm ready.
All right, man. And for the second week in a row, I'm not paying him to say that, folks. People actually watch this stuff, and it's a lot of fun. So, Kyle, if you would, go ahead and give a little bit of an introduction as to who you are, what you do, and how that relates to mortgages.
Yeah, fantastic. I am a loan officer or a mortgage advisor for a mortgage company. We are a non-depository lender, Fairway Independent Mortgage Corp. Our office that I'm a part of is in Crown Point. We are about 200 strong here in the state of Indiana and about six-ish thousand across the country. But we are a national brand, probably the largest lender you've never heard of is what we like to joke about. And I have to pull up the exact data, but I want to say we're in the top 5 to 6 retail lenders, year over year, and we could Google that or look that up and blip that in if you need to. But yep,
Gotcha,
so
gotcha. And so when we talk about a non-depository lender, that effectively means you are helping folks source money outside of a traditional depository institution, a la Chase.
Correct. Yep, exactly. We're like another Rocket Mortgage, if you will, just better because we answer our phone. So no offense to any Rocket loan officers that are watching this, but it is true, and that's kind of our one of our mantras or mottos is we're across the country and nationally strong, but local and in tune with the markets there. And you're absolutely right, non-depository lenders. So we don't offer anything aside from lending. It's strictly that. Strictly residential mortgages. There are brokered channels that we dive into for any kind of unsecured loans or equity lines and corporate commercial loans or LLCs, and the list goes on and on and on. But predominantly residential QM mortgages, qualified mortgages.
Perfect. And so the average person would interact with you primarily when they're looking to buy a home. And so let's tee this up in the situation that somebody is looking to buy a home for the very first time and they find themselves doing that in late 2023, early 2024, and mortgage interest rates are the talk of the town because they're as high as they've been for anybody in their adult life if you're basically under the age of 35 or so. And so
I
that makes
agree.
that
Accurate.
that makes the phone call to you a maybe not so pleasant one because stuff's really expensive right now. And so how do we start to frame this discussion of what we can control versus what we can't?
Yes, you're a newbie to the market. You see all these headlines. You talk to somebody like me, and it's a completely green to the conversation. It's a scary time. I get it. It's not easy for anybody, but especially a buyer, experienced or otherwise. In terms of what does it look like, it's at first it's a conversation, and we aren't order takers. I think it's important to identify that we don't get paid until the loan closes, but it's so much more than that. We're not getting paid on a rate or a loan product. That's actually illegal. That went away during the housing crisis, and in part it was due that kind of cost it was predatory lending practices. So there's a lot of red tape now and a lot of regulation. And it's important to identify somebody that you get along with, have a couple different options, but somebody that truly understands your situation to identify, there are a gamut of options, and a couple might make more sense for you than others. But my job is to help you identify that through, that exploratory type of phase. It's not just a, unfortunately, it's not just a push button get mortgage, as much as the marketing likes to make you think so. That's good and well, and it can be that way once we, have identified which product it's going to be. And get some feedback from that client too. We want to meet the client where they're at. So that's it's a scary time. It's an expensive time. We understand that, and we're a team. The picture I like to paint is, especially if you're new, all the pieces of the puzzle are face down right now. So we're going to work together to turn each of those pieces face up, build a big picture so you can make an informed decision.
All right, that's a good way to frame this, and maybe we'll continue on with that analogy. And when I start to think from
Mm-hmm.
my experience in terms of flipping up those pieces and turning them over, the ones that come to mind are, for how long of a term am I looking for a loan? For how much am I able to put down on a house? And
Yeah.
for, essentially, am I looking to get a rate that's fixed or a rate that moves around? Are those the places that you start, or do you start even bigger picture than that?
Yeah, even bigger picture than that.
Okay.
And but it also depends on where that person is. For an individual like yourself that might be in a home, and your family needs might be wildly different than a first time buyer that just started a new salary position, that has some student loans, that doesn't have a down payment, that doesn't have the work history. When I first started in the business, I could barely spell FHA. Now there's a lot of variables. So, but I'll address it from your seat, just to make the connect. You're absolutely right. We're going to talk about, the time that it's going to be, you're going to be in the home is important to identify, regardless of where you're at in the, buying experience. I think it's important to understand, hey, I'm going to buy this home as a starter, or I'm going to buy it as a, 5 to 10 year type thing, or hey, I've looked at some statistics and my job thinks I'm going to stay in the area for a very long time, or hey, this is going to be my last one. I want to retire debt free in 10 to 15 years. How do I double up on payments to make that make sense, regardless of term? If the market's heading in a lower rate environment, is a fixed okay? Should I refi later? Is an adjustable? How expensive is it now? The list goes on, but those are just a couple priming questions that I know you would understand, and we could dive into those, if that was the case. But yeah, somebody new, I like to identify it as income, assets, credit, bare
Okay.
bones. Those are
Okay.
the pieces. How are you paid? What type of pay? What's your credit look like? Not what Credit Karma says. Ask Credit Karma for a mortgage. They're not going to give you one. It's important to know that your Vantage score and your FICO mortgage score are two different things. We actually have 8 or 9 different scores based on what it is we're shopping for. So we want to talk about that. And if, maybe there's something we can identify on the credit report to help you improve that score, that's the key. Higher the score, to lower the rate. Everyone wants to save money right now. And then assets. What have you saved up? Are you eligible for any down payment assistance programs? Are you a first time buyer? Do you get a discounted rate? Have you heard of mortgage insurance and what that looks like? Do you know how to mitigate that if you don't have 20% down? What are some things that you've heard that make you feel uncomfortable or kind of scare you? What can I do to kind of help start to address those? So those are, I start basic, but to answer your question, it can be as granular as you need it to be.
Yeah, I appreciate all of that. And to thoroughly discuss each and every one of those, this could get to a length of show that could end up rivaling Joe Rogan. And so we're gonna pick a couple of those and dive in on
Okay,
them. And
cool.
and where I want to go with
Sure.
that, you talk a little bit about better credit, better score, better rates. I have
Yeah.
heard
Okay.
before, and I want you to potentially squash a rumor here that basically around the 700 mark of a credit score, you've hit the peak, and anything above that, your rate's probably going to be the same. Or am I hearing things that you have found in your own experience? Is that real?
Um, yes and no.
Okay.
The old adage of, hey, I need a perfect credit score. I need a score in the 700. You don't need a score in the 700s. You could have a conventional mortgage as low as a 620, but you better hope you have a large down payment.
Sure.
So loans you're eligible for, and then loans that just don't make financial sense are also, they're all on the same table, right? So I think it's important to identify, again, you're right, higher the score, the higher the payment. But I think the tiers would kind of fall into, once you reach 700, 7 to 720 is a bucket, 720 to 740 is a bucket, 760 plus, the quote unquote bare bones, if you will, kind of programs, you're going to see it be least expensive anywhere past 25% down, and a 760, depending on product, maybe 780 score. The loan amount's not going to have any bearing on a conventional loan. The property type could, like if you look at a condo versus a single family, it's risk based. Same thing with a manufactured home, it's risk based, but now we're talking granular things. So keep that in mind. 25% down, 760 score plus. There's not really any kind of what you would call loan level price adjustments. And I say price adjustments meaning things that make it more expensive. Um, the lower in the score you go, now it maybe is more advantageous to look at some of the government loan programs. And while they're pricey too, it might help you get into the home that you need or want now versus, okay, if I'm not willing to pay that now, what are the steps I need to do to get to a less expensive territory in terms of loan product, but maybe helps me afford more home. So that's kind of the evolution. So you're right on some sides, but it's a starting point on other sides, if that makes sense.
Got it. Got it. And so, if you would, I want to talk about mortgage insurance just to paint the picture and explain exactly what that is, who it applies to, and as a
Yeah.
general rule, how much does it cost?
Yeah. Mortgage insurance, no one
Yeah.
in our industry agrees with it, right? And I'm the lender that has to shop for it for you. So mortgage insurance came to be, in and around the 0809 crisis. And the idea is that it protects the investor, not the originator, not the client. It protects the investor should you ever foreclose on the property. Doesn't mean they're paying the bill for you. They're just helping ease the pain later on down the road, right? And it's designed to be in place for any equity position lower than 20% down in the conventional world. So we'll talk conventional, which is Fannie Mae, Freddie Mac, different conversation, different podcast, and then government realm. So in conventional world, mortgage insurance, or MI, is what you'd hear it referred to, or PMI. Anything less than 20% down is required through Fannie Mae and Freddie Mac to have mortgage insurance. Now, the less you put down, the higher that number. The lower your credit score, the higher that number. It's risk based. Okay. Now, as a first time buyer, there's programs that allow you to kind of discount that, which is good. But these entities, they're third party. While Fannie Mae and Freddie Mac does require the loan originator to have them on the product, right? We shop for the cheapest one. It has to be the cheapest one. Why would I pick the most expensive one? It doesn't help anybody, right?
Yeah.
So you want to identify the monthly charge, and it's a factor of the loan amount divided by 12. So it's a percentage. It's all over the board. But let's, in this example, say it's $80 monthly because you're not putting 20% down. You're putting down whatever your scores, whatever the monthly is 20 or $80. You can actually, if you don't have the 20% down, you could purchase that $80 monthly one time out front in the transaction called single premium.
Mm-hmm.
Well, it's important to identify how long you're going to keep the home and what
Mm-hmm.
that number is. If it's $8,000, well, you need 10 years to make that make sense, right? Rounding. But maybe the seller's going to pay for that charge and you're not going to refinance, because if you refinance, you don't have the equity position, you don't get that money back.
Right.
So
Right.
single premium kind of comes into play when you're right on the edge of maybe 20% down or not, or maybe we have a type file that the monthly MI, the buyer just doesn't want or can't afford. So in order to make this work, us or the buyer or the seller or all three are going to pitch in to make this single premium make sense. There's times when that, is relevant or needed. So single premium and PMI for anyone watching, those are kind of your two lanes. If you do need mortgage insurance, you ask your lender, what's my monthly and what is it going to cost me to buy it out? Help show me if that makes sense or not.
Yep. Yeah, that was a direction I was going to take this as well. That's something that I entertained in my own life about 10 years ago, and it ended up being
Yeah,
fruitful. So definitely have that conversation with your lending folks to see if that
yeah.
makes sense.
Yeah, and I think it's important to say, okay, $80 monthly. Okay, Kyle, you didn't talk about for how long. Well, it is conventional mortgage land. If you need PMI, it's automatically going to fall off when you've reached the 22% equity mark on the original loan to value.
Mhm.
Okay, you can request it to fall off at any time.
Right.
You buy a home now, you have 5% down, and tomorrow it appreciates like crazy. There's actually a rule that you have to wait a certain amount of years, 2 years for that to happen, but neither here nor there. So let's say the 2 year seasoning period's gone, it shot up past 22%. You could call that servicer and say, I need this off. You pay for that appraisal, you walk through their procedures and policies to get that off. Government land, the mortgage insurance is on it for the life of the loan. Okay. Most products. So FHA, it's you'll see it monthly. USDA, it's called a guarantee fee, same thing. VA, it's a funding fee. It's a one time, it's not a monthly. And that's provided the veteran needs it. Some veterans are, they have the disability or any kind of benefits through the VA that waives that for them. And their certificate of eligibility will show that. Conversation for another day. So, yeah, there's ways to mitigate it, is my point.
Fantastic, my man. I appreciate you breaking that down. And so, as we take our next piece of this conversation to start chewing it off out, I want to propose a situation to you based on things that I have heard in the past, and this is a question that I've greased the wheels with you personally a little bit on. Is that basically
You did.
you can boil the costs of a mortgage down to three different pieces. It is the interest rate, it is the origination fees, and the opportunity to buy yourself into some discounts. And so we
Mm-hmm.
probably ought to start with talking about what buying into a discount means, but we'll get to the
Yeah.
point where essentially you get to pick two of them, and those will be your two best options, and one of them will inevitably sneak up and get higher. And I want to get your take on that, because it seems to me, if you ever had one of those dolls as a child where you squeeze the head and the eye comes out, but if you plug the eye, something comes out of the ears, it just feels like that's the sort of tension that we have ourselves in when we're trying to get the best of all three worlds in a mortgage. And
Yeah.
maybe
Yeah.
we can. I'd love your feedback on the whole idea there.
Man, that's great. That's a great analogy. I've never thought of that. I'm going to borrow that if you hope I don't mind. If you don't mind,
Please
I hope you
do.
don't mind. Excuse me. That's a good one. Because just like it feels that way from the consumer standpoint, it very much feels that way from the lending standpoint. It's this guideline doesn't work, and I got to do this, and so you're just trying to plug all these holes. It just something else is spewing out. So that's funny. But yeah, so great question. So let me preface this by saying you don't shop for a mortgage like you shop for a car. And I think that's the video that got you and I talking in the dialogue a little bit. And it's true. If you walked into a bank or lender tomorrow and you said, what's your lowest rate? They're going to go, what rate do you want to see? There's a time and place for that. And it's not a smart aleck answer. It's literally the answer, right? And then you get into the variables. There's at any given time at least 12 to 15 different variables. And I'll roll them out, but I don't need to for the sake of this video. They exist. Credit score and down payment and property type we talked about.
Mhm.
So changing gears into what a discount point is. Unlike when you finance a car or an unsecured loan, in mortgage land, you could pay interest up front to save interest long term. I did a video, I think, the other couple of days ago where it's defined that discount point. A discount point is, or points, is 1% of your loan amount. So one discount point, 1% of your loan amount, easy math, $400,000 loan. If you decided to purchase one discount point, it's going to add to your closing costs, 4 grand. Pretty easy track so far, right?
Mm-hmm.
What that 4 grand saves you is based on the market that day that you locked and purchased those. It's added to your closing costs at closing, but it's that lender locking down that rate for you. So let's say that market, saved you 0.75% in rate from your bait, and that saved you $100 a month in payment. You're going to divide the 4,000 by 100. You're going to get 40. You're going to divide that by 12, which would be years. So you could look at 40 payments, or you could look at 3.3 years and say, hey, I know if I refinance that home in month 12, I lit a $4,000 check on fire, right?
Yep.
Now the home could appreciate, and it is tax deductible, the discount points and the monthly savings. Let a CPA correct me on that, because a subsidy isn't, a permanent buy down might be. So I foot and mouth on that. I know monthly interest is permanent. Let's check.
Yeah.
Tax deductible to a degree, right? And so you want to identify, am I lighting money on fire, or is this going to save me? Because $100 over 360 payments, well, that's kind of a no-brainer. That's a wise investment. So that's a discount point in summary. Here's where you get in a trick bag. I saw this online lender, they're offering 4.9, I'm making it up a number, 4.99. And they put some disclosures down there. In the disclosures, they have to put how much that rate costs, if there's a cost associated with it. If there's no discount points associated with it, you're fine. But if it costs 18 grand to get 4.99, well, that's where you hear the horror stories of I've got my closing disclosure, and a week before closing, I need 18 extra grand. What the heck happened?
Right.
You had a lender that didn't explain it, or maybe they did and they did it in a very poor manner, and it didn't serve you the best. So you want a lender that's responsible, reliable, that can help you identify it's your option on rate. Let's talk about that timetable, right? Let's talk about the purpose for the loan. Let's talk about, maybe when you get pre-approved, you might think you're going to purchase a discount point because the way the market is, or if you're going to negotiate with the seller. But maybe the house you find needs a fence or a finished driveway, or you want to finish basement or something. Well, now all of a sudden those points are going to be maybe used for that thing. So it truly depends. So I'd say be flexible with it. Understand that it's available. Understand that it may or may not make sense for you as a buyer, and ask your lender, hey, what's my range of rates available today if I'm locking a rate today based on my
Yeah,
circumstance?
I think that's the right way to frame it, is that up front when you're buying this house, you essentially have some pool of money that you've saved. This is the money that you're going to contribute
Right,
towards your house in some capacity or
right,
another. And maybe it's buying down that
right,
rate, maybe it's putting it towards your
right.
down payment, maybe it's building the fence that you're talking about. And
Yeah.
it's a world of high school economics and opportunity cost. It really is. And so I appreciate you breaking that down, and I really wanted to spend some time on that because it paints the picture that there could potentially be a scenario where choosing the lowest mortgage interest rate may not be in your best interest for a number of different reasons. And I think that based on what we've
Right,
been talking about, that
right.
could be factual,
Yeah.
and that's just not something that
Man,
goes
yeah.
into the normal thought process as you see the Facebook pontificators doing their things.
No, no, I was going to say, yes, you're absolutely right. And that's something I learned very quickly in the industry, because when I started in 2019, then COVID came. And I'll start by saying I did a lot of back end work on the mortgage industry before I was front facing as a loan officer. So I did a lot of the processes, and I learned how to read a loan estimate because I built them. I learned the loan product guidelines because I had to, and I also wanted to because that's your advisory role. But that's something I learned quickly is, oh, well, XYZ Bank said they could give me that. Did they pull your credit? No. Okay. Do you have a loan estimate? Did you lock that rate? No. Is it could literally text them the next hour. Good luck texting a bank. You could text them the next hour and that rate be different depending on how volatile the market was. Now you're not talking percents, you're talking tenths or hundreds of percent. So, it's not, when the pendulum swings, it doesn't swing past the point of, hey, I'm not pre-approved anymore. And if it does, your lender didn't do a good job of telling you where that market's headed or at. Um, Conversation for another day. But you hit the nail on the head. Hey, the most expensive or the cheapest rate's not the cheapest mortgage. And we could do another conversation on amortization alone, because amortization is a black belt of lending. I've done the math, and it depends on loan amount, rate, cost, things. But there are some scenarios where you might have a higher rate and less money down versus a lower rate with more money down, and apply that principal on month 2, 3, or 4 to the principal balance only. That larger rate, larger balance, because of how an amortization schedule works, will be less interest if you make all 360 payments. So you spent the same, you thought you got a deal over here, but because of how interest is accrued, It's wild.
Yeah.
It's wild, and the math doesn't lie. So that's something to kind of dive into, maybe in a separate thing. Maybe we could share screens and get into that. But that you hit the nail on the head. I've got 100 grand to use towards this house, or I'm a newbie and I've got 20 grand to use towards this house. The thought process is the same. How long are you staying in the home? What's the home's purpose? Is it going to be a primary or eventually a rental? Are you fix and flip? What's it going to be? And then maybe we talk about spreading that money around doing a little bit of each. Maybe you put some towards the discount points. Maybe you put some towards the down payment. Maybe you put towards some sweat equity. Well, bingo, now your dollar goes further because you didn't just look at it in one lane. But if you gravitate towards the lower payment, lower interest, maybe that's your lane that you be in, because you're going to be in that home for the next 15 years and you're risk averse. You don't want to refi. You don't want to sell. You don't care. Buy once, cry once. There's your lane. The repair guy might want the equity, right?
Yeah.
You might want the equity. I'm going to do it myself, whatever. The other person with the down payment might want to, instead of throwing all that down, maybe they have a high interest credit card they want to pay down instead. And now that $300 or $400 savings per month on the credit card bill, they can apply towards the principal balance on the mortgage, i.e., saving them more interest through the blended rate. So, I mean, how far do you want to take it? It's really how long are you willing to pay attention to me rant?
Totally.
But I understand, meet clients where they're at. I don't want to just throw up information and say good luck. In a client setting, it's very much what's the goals here, because that's going to help dial in what kind of routes we go versus just, I'm so over inundated with information. I can't make a decision, Kyle. You scared me off the fence. I didn't help you, right?
Yep.
So you really want to get personal and truly talk. Clients become friends. We chat on Facebook. We see their families grow. I mean, some of my favorite memories as a loan officer is seeing the Easter and the Christmas and the Thanksgiving. They have their family over to the house for the first time, and I'm like, I kind of played a role in that. We've got the numbers, the boring side. Realtors have the fun side, right? But I helped. So that's a really cool thing. So.
Totally. And if this episode does one thing for one person, it's to make sure that there's somebody in their corner that knows this stuff like the back of their hand, like Kyle does. And so wanted to draw some attention to the high and the lows of finding a mortgage in 2023 and 2024. And I think we did a fantastic job knocking out some of the key points to that. Kyle, I would be remiss if I didn't ask you to hang on for a handful of rapid fire questions known as the how-to cues. Are you ready for that?
Oh, no. Hold, please. Yes.
Yeah, right after the swig. That is excellent. Question number 1, I'll read them over here so you got a bit to think about them. What is the best book that you have read in the last 12 months?
Oh, actually the one you recommended, The Power of a Moment, or the Moments book.
Yeah, The Power of Moments, absolutely.
I'm on Do Not Disturb. I have to fill it out. I'd have to pull it up, but I audiobook, so I don't actually pick it up and read it.
Yep,
fantastic. Recommend it. Awesome.
Yes, The Power of Moments is so fun. If you follow me on Facebook, you can see the videos of me taking a baby koala everywhere I went to. It's a different conversation outside the premise of this video, but go check out The Power of Moments. It's a fantastic book. Second question, what is one podcast that you subscribe to?
So a couple. I follow the whiskey podcast. There's a pair of guys that does I can't think of the name, and then Inky Johnson's podcast. I love his stuff. And then there's a couple local realtors that have some content they put out locally, so I can share that with you, and you can tag it in your descriptions. So, but yeah, Inky's probably one of my favorites.
So. Excellent, sir. Question number 3, what is one app on your phone that you cannot live without? And don't you dare say a mortgage calculator.
I've actually grown very fond of some of the helpful artificial intelligence apps. In the moment, as a rapid fire, I would probably say, CapCut. I've used it a lot to put some reels and some very informative information together where it might take me a long time to get that out,
Okay.
or I'd have to pay for it. That's been really affordable and easy, and fun. But the calendar app,
Totally. I can appreciate
I
that.
need it.
All right. What is one item that you've spent $100 or less on in recent memory that's brought you tremendous value?
Oh man, I'm a sucker for a really good fresh ground bag of coffee.
Okay.
I happen to like Lavazza as a brand. Um, I buy it for the office, and everyone kind of shares it. And the bag is gone in a blink, but there's just something about that aroma in the morning, and then I like the smell of coffee versus the taste. But um, yeah, so it's the little things you find joy in. Bag of
Total.
coffee is one of them.
Totally, totally. And the final question,
Yeah.
where can people find out more about you or connect with you or
Yeah.
get in touch with you?
Obviously the informalities of social media. You can see a little bit about me, what I do day to day, but then also, the intention and fun I have with my family and friends, and also office profession as well. But the KH Home Loans website,
Mhm.
which that domain's changing, so I'll give you the direct link versus the routing link.
Okay.
You can see the reviews, all 115 of them now. I think you can read through those. You can interact with some pages that Fairway puts out in terms of content. You could interact with the loan calculator. You could read about the loan programs, but Instagram or Facebook, a lot of the content I put out is just meant to be quick and informational. Um, just a text away though. So
Perfect. Perfect. Kyle, thanks again for joining me on this episode of the show.
thanks for having me, man. It's a pleasure.
A special thanks to Kyle for joining me on this episode of the show. And if you have any follow up questions, leave them in the comments and I'll make sure that those get answered and talked about. We want everybody to feel comfortable in this process, and so getting an expert on your side is key. In the mortgage industry, definitely you want to get an expert on your side, but in the real estate world as well, want to have an expert, and I can be that person to you. If you're looking to transact real estate in the Indianapolis market, get in touch with me, either in the comments or at indiedwell.com. If you like the content that's coming at you, each and every Wednesday, you can hit the subscribe button to be the first to know about it, and you can follow me that way, and that'll make sure that you can check out future topics that we're covering on the show. And if you have an idea for a future topic on the show, you can leave that down in the comments. I'll make sure I interact with those as I always do. Until next time, this is Anthony Drew Gary, host of The How To Show, signing off.